Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Well, thanks again. I've been off for about a week or so, and a lot has changed. Markets are going up and down as they normally do in various fashions. So we're going to go through three headlines today. Stuff that we're watching here at Blanke Schein Wealth Management and paying attention to for our clients and taking advantage of, so you should be too. Thanks for watching. So first out of the gate, our mid-year outlook is next Wednesday, July 14th, Pacific time, 10 a.m. Mark your calendars. Send us an email. We'll get you signed up for that Zoom call. I'll go through all of our research, all of our investment committee, and our thoughts and our thinking for the second half of this year. Now, the first half of this year, obviously, we had a lot of ups and downs, especially in the Treasury market, right? The 10-year Treasury, as I've discussed, set higher highs, and now it's backed off again. Even today, the 10-year Treasury is down now below sort of the danger zone that we discussed earlier this year. And the reason why is, well, there's a lot of headlines right now. 10-year Treasury just hit, as we had trading today, about the 125 level, 1.25% for a 10-year Treasury yield. And that's the lowest level we've seen since last February. Remember, it went all the way up to 1.7 and now hit the ceiling and bounced back, and now traded all the way down to 1.25 on the 10-year Treasury. What does that mean, Rob? Well, the take-home point here, real briefly, is the reopening trade and the global reopening in terms of the surge of growth sort of tapering or slowing down or losing steam, if you will, simply because of all of the global conversations. If you look at the headlines overnight in the last 48 hours, and it's been steaming for building for a couple of weeks, but really came to a head over the last 48 hours. Maybe markets, specifically the Treasury yield, is telling us something that globally, not the US, but globally speaking, the COVID-19 variant, I believe we're on Delta. We had everything from Australia to India to every country. Now they switched it to Greek letters. I think we're on the D's for the variant. And that seems to catch headlines across the world. Right now, it seems to be a concern because obviously the rest of the world is not as vaccinated as the United States. Therefore, you sort of have this breaking out all over in different variations, in different forms, depending upon where it is, geographically speaking. That being said, Big Pharma came to the rescue today, actually just announced that they're going to have a booster shot coming in the next 10 to 18 months, if you will, for those that have been vaccinated. We'll then have another round of vaccinations. That was announced by Big Pharma today. So we'll see how the market sort of plays out. But the 10-year Treasury, very specifically, is sort of slowing down. And there's an inverse relationship. We here at Blanke Schein Wealth Management love volatility because we take advantage of it for our clients. Earlier this year on the equity market, we all saw this, both growth and value, right? Value started outperforming growth. It started last October and it continued. And now recently, large cap growth started outperforming value. And it really speaks to the fundamental belief that we have here at Blanke Schein Wealth Management, which is balance and high quality. That's the key to anything. And that's how we go with our mindset to building and constructing customized portfolios for our clients. Quality will never go out of favor. And in fact, you use the asset allocation. What I have here on the board is really to show you how we take advantage of things. And my art project here today, and my happy little tree in the corner, that's an autograph from Bob Ross. That's how we're going to start this today. But my kids will be happy to know that I colored within the lines for the most part. That being said, this is an asset allocation, sort of fixed income, stocks and bonds, and balance with alternative investments such as real estate and traditional alternatives and cash. So we have a 50% in stocks, which is blue, portfolio, hypothetical portfolio here, but not too far off on how we build our portfolios for our clients. And a 40% bond allocation with a 5% alternative investment. Again, it's alternative investments, real estate, and a few others in that category, as well as cash. Precious metals as well are also in what we call the alternative investments. So gold, silver, and a few others. And then cash. Cash is the most important on here. And that's where we come in with the strategic rebalancing, as in the title of this today. All it means is, as we have volatility, as I said before, the 10-year Treasury has been extremely volatile this year, going up. When interest rates go up, bonds go down. So bonds will shrink on this portfolio allocation. And the traditionally stocks in this will be a larger, greater asset allocation. And at that time, that's when we start selling a little bit. We'll trim a bond position when bond prices are super up. That means at the opportunity to sell high. And then we will reallocate that when stocks will take advantage of and reallocate that maybe in some stocks that we like, maybe growth or value in the large cap space, depending upon what looks attractive at the time. And the best part is that we always carry some cash on our portfolios. Why? Because like we saw today, when Treasury yields went super low, bond prices, so the bond allocation, increased in value. In fact, when bonds are down, interest rates, where interest rates are up, bond prices go down. It's also an inverse relationship. Sounds complicated. It's really basic when we take advantage of all the market fluctuations and volatility. So that's why we take advantage, and we take special note to the 10-year Treasury or just interest rates in general. But underneath the fixed income market, we look at the credit quality as well as the credit stability, right? Is credit markets, are they holding up, or is it going to be an indication of a greater sell-off? Right now, as it stands right now, even though the markets are down about 500 points at the middle of the day and trading day on some of the indices today, the credit is still holding up. And the 10-year Treasury, again, tested the 125 level. And who knows, we might have a retest. Oftentimes we do. That being said, this is the asset allocation, and the red part is the cash. We've seen a lot of influx of cash from clients, from their banks, right? And so the bank money is not earning you anything. We know the Federal Reserve is geared towards reinflating the market right now in terms of being a support, but also gearing towards inflation and going to let inflation run hot. So if inflation is at 2%, that's their target, and the bank is paying you 0 or 0.25% on your money, you're effectively losing just under 2% in this full year on your money. It's called quicksand. So what we see is a lot of influx of money in the client portfolios. We've seen a ton of that year to date, and we put it to work as this volatility gives us the opportunity. You just have to be patient, as we are, and we like to see that. That being said, there's all the inverse relationships that I'll go through on a later date. But we're also seeing on headlines change, as I said, in the last 48 hours. We're going to pay attention quite closely as to the variants and how they play out. We know that the Olympics right now just canceled the Spectators in Japan, which is probably most likely the right move. Ultimately, unfortunately, the parents of the Olympians are usually the ones that are going to miss out on this one. But you got to do what's right at this moment in time. And I'm just amazed that they're proceeding with the Olympics at this point in time. So good luck to all the Olympians. But that's sort of a test right now or an indication as to how serious this is on a global market. So we will pay attention to the 10-year Treasury. We'll pay attention to what the equity markets give us. And again, as yields come down, bond prices go up. And as bond prices go up, we start trimming some of our bond positions, meaning selling high, and then reallocating to some of the stock positions that we like. Now, it wouldn't be out of question or uncommon, and prepare yourselves for, as we are, that the next back half of the summer becomes a little bit more choppy and a little bit more, let's put it this way, give us opportunity, but we could see a 5, 10, 15% correction on the major indices. If we see that'll be a great reset, and it'll push us back to obviously lower levels, but give us an opportunity for the markets to reset, but then finish strong at the back half of this year. So it's not something we're concerned with, it's something we're prepared for, and ultimately we're going to use the asset allocation in everyone's portfolio to strategically rebalance and take advantage of market volatility. So that's it for today. Thanks for watching, and I'm sorry for all of our friends in Wisconsin that are out there, but I'm going for the Suns, born and raised Phoenix Suns fan, and it's been exciting. It's been since 1993. We were back in the finals. We had Charles Barkley versus Michael Jordan back then, and I watched every minute of it. But that didn't turn out too well for the Phoenix Suns. It was actually Michael Jordan and the Bulls took advantage of the finally took the NBA title that summer, but it was a great summer nonetheless, and it was fascinating for me watching. So this summer I'm watching with my kids, and hopefully it's a different story for the Phoenix Suns. So go Suns. Thanks for watching. Take care.